You were talking about money, right?
Separate yourself widely from the pack moving forward. Is that something that you would be willing to have a discussion about?
Because they didn't get it. They were
Probably
like,
didn't
right.
get it. Yeah.
To follow up with your clients, to generate more leads. You know what I mean?
Always check to make sure you're recording.
The record, yeah.
Clap and I need to start over and all that jazz.
Oh, Lord.
All right.
Yep.
We're going 5, 4, 3.
Welcome back to another episode of Key Factors Podcast. I am your host, Mark Jones, and we are sponsored by ReviewMyMortgage.com, which is the largest index of mortgage programs nationally. And today I have a pretty awesome guest who has been in the mortgage industry for quite some time, well respected in our industry, and I'll let it speak for himself. John Hudson. John, how you doing?
Awesome. Thanks for having me.
Absolutely.
Before you say, okay, boomer, I'm only 44, right? So it's the years, not the mileage.
Absolutely.
Yes.
That's exactly right. And I would imagine that you being so close to the millennial boomer age, you've adopted a lot of the millennial traits, right?
Absolutely.
Cool.
Now, I still have my 8-year-old teach me some things
There you
on
go.
the phone, which is pretty amazing. But 100%, you got to adopt technology where you can.
Or you'll be left behind.
Or yes, you will be left behind.
So we're going to get into a lot of that stuff. We're going to get into what's going on with our market. We're going to get into what we're seeing out there and what's actually happening. But before we do that, I want to tell the folks or give the folks a picture of your story. Some folks don't know who you are, what you've done, and I'm very impressed and have been for many years. So tell us about you. Where'd you come from? Where you at? All that jazz.
Born and raised here in San Antonio.
Awesome.
Yes.
Likewise.
So love it here. Spurs fan. This is
Go Spurs, go.
Puro San Antonio, right?
Absolutely.
Went to high school at TMI. Actually, believe it or not.
Right down the
And
street.
It's literally across the street from my office, which is kind of weird. It's
That's
like,
cool.
Has flashbacks. I actually now live in the same neighborhood I grew up in.
No way.
Which is bizarre too. So think about this. My morning commute, I'm leaving Bluffview and I still drive over to Camp Bullis and I-10.
Wow.
Now think about this. 1604, finally they've started construction there, but it's looked the same for the last 25 years.
Yeah.
We've only added a couple million people to San Antonio
That's
since
so
then.
true.
So here we are.
And now they're trying to expand it, which has been a nightmare, but definitely needed.
It's on its way.
Yes. Amen.
But how I got into mortgage is actually kind of an interesting story. Nobody wants to get into mortgage. No one goes to college and says, you know what? I'm going to do mortgage. I literally fell into the business like so many people do. I was looking for beer money.
Okay.
While I was before summertime.
Sure.
Right? So I found this thing on the employment board for an internship at North American Mortgage Company.
Okay.
Which at the time was the third largest mortgage bank in the country. Literally had no idea what I was doing. I was that guy that got his tie caught in the paper shredder on my first day.
Okay.
I had that tie for like 10 years. It was awesome. It had the perfect little slats from where the machine cut it. Great memento. Make a long story short, though, I was a loan officer assistant for a top producer in that office and finally got to go to my first closing.
Okay.
Had no idea really what it was. I was still learning. I was new. And I can't remember the lady's name, but I'll never forget her face and her hair. Long blonde curly hair. She was wearing blue nursing scrubs and she started crying at the closing table.
Oh, wow.
And it was like
and
tears.
This was the buyer.
Yes, this was the buyer. This was the borrower. Tears of joy. And she said that she finally did it by herself. She got her and her kids a house and a backyard to play in. Now, so single mom, nurse. Well, my folks split when I was a kid. My mom was a nurse. So it kind of like it was a sign from God. It tugged at the heartstrings. And I realized that, wow, this mortgage thing is pretty powerful. Mm-hmm. We impact people's lives for the better.
100%. Yes.
And since then, I really just became a student of the business. I literally left and went and bought a book called How the Bond Market Works.
Okay.
So, they don't teach you mortgage-backed securities in college. So I kind of had to teach myself to a certain degree. And then continued to be residential loan officer, working with consumers. Made a flip over to the wholesale side.
Okay.
Where we served mortgage brokers and bought loans basically from folks all over the place.
Just for the laymen that are listening, we've got a lot of consumers that tune in. What is wholesaling from your perspective?
So the best way to describe wholesale is if you're a consumer and you're going to go talk to a mortgage loan officer, they either work for a mortgage bank, which means they do the underwriting, or you go talk to a mortgage broker, which means they're essentially the originator of the loan, but they're going to shop and find the which ultimate investor that where they're going to make their payments to.
Gotcha.
It's really all about who you know, who you develop a relationship. There's pros and cons to using one or the other. But at the end of the day, it's about, do you have a connection with that loan officer that's there to serve you and put you and your family into a home? Trust is so important. So I served the mortgage broker side. Then I became very politically involved. There was a lot of regulations that made our jobs difficult, made it harder for consumers. The old saying of the road to hell is paved with the best of intentions.
Absolutely.
And so somebody had to be a voice, for consumers and small business, and to not let government overreach, make things too difficult.
Sure. And what year was this, to put it in perspective?
Gosh. When did I testify? So this was now 2012.
Okay.
Is when I testified before Congress.
Gotcha. So after the 2007, 8, 9 debacle, and again, it took a couple of years for that to kind of set in.
Yes. So that was actually a crash. So
that was a true crash. That's
that
right.
was, and I know we're going to get into this, but man, it was such a different time. There was such a desire or an appetite for new loan originations that people continued to loosen the credit box.
Sure.
And it finally got to where, well, if you could fog a mirror, you can get a loan.
Yeah.
Without having a responsible qualifying behind that. Now, there are some parallels that I think we could draw to where the industry is at today, but we're not in a crash.
No.
And we're not going to get there.
No. And I'd like to get into that, but not just yet. So you being the EVP of Mortgage Financial Services, how did you make the decision to go that far down, let's call it the rabbit hole of mortgage? And the reason why I ask is I myself, top producing loan officer, had an opportunity to become a branch manager. And like you said, became a student to the game and love the fact that I can be seen as an expert in this industry. Right. But going out and creating your own brand, your own image, your own actual mortgage brand, what's that like? I mean, what made you shift all the way there, if that makes sense?
Again, I think it just boils down to passion. Even my little motivational quote today was from John Maxwell. People don't care how much you know until they know how much you care.
That's true. I love John Maxwell.
And that's why
make today count
every day.
Absolutely.
Do it now. Do it now. Do it now.
Sir.
No, so I think it's that passion. And I keep coming back to that first closing I went to and seeing that woman cry.
Sure.
And realizing that, man, we really do we do as mortgage professionals do a lot of good in the industry. And, unfortunately, from the 07, 08, 09 crash, the economy, the mortgage business got a really bad rap.
Yeah.
And I think mortgage loan originators got a really bad reputation. I mean, there was a period of time where people trusted us less than car salesmen.
That's right.
And members of Congress.
Absolutely. Touche.
So I finally decided, you know what? I just need to make my own brand. So I tag everything with #MortgagePro because I do feel that I am an expert in the field. And I tell people all the time, I really don't care if you're a mortgage broker, if you're a mortgage banker. If you're in this industry and you're serving consumers, you got to do the right thing all the time.
All the time.
And be involved and be engaged. This industry isn't for folks that are just in it to make a quick buck.
Right.
This is for people that are going to make meaningful impacts in families' lives forever. Back when I was doing a lot of the political stuff, after the 2010 census came out, there were some pretty crazy and telling statistics in there. And it was demographics and household net wealth. And this was the 2010 numbers now, but they're still stuck in my mind. The average household net worth for white families was $121,000. For Asian Americans, it was $69,000. For Hispanics, it was $74.55. And for African Americans, it was $49.80. Household net wealth.
Right.
How is that even possible? I mean, this is America.
How is that possible without getting political? I mean, right. Because my brother and I actually have, him and I both being mixed race, we've had this discussion quite often, especially when we're overcoming a borrower in that situation.
Right.
And that typically is when that comes about, that we flip on our Zoom screen and go, hey, we're the same. Come on now.
There you go.
But go ahead.
Yeah. So when you really dig down into the numbers, the key driver in that differentiation is home equity, home ownership.
Right.
And the percentage of home ownership for white families versus Asians versus Hispanics versus African Americans, huge disparity.
Absolutely.
So now we go back, come full circle. Okay, mortgage professional, what do we do? What should our mission be? And that is, we should be putting families into responsible housing. And you know what this, and again, owning a home isn't get rich quick.
Right.
We all should have known that things were coming to a head when
Absolutely.
Flip This House became a top rated TV show. But we're talking, long-term generational wealth, and how do we set people on the right glide path? Mom, dad live in the house, they pay it off, they pass away, and now there's an asset that's being passed down for generations. So
Right.
transgenerational wealth creation. So that's where my mission just kind of came to be. And, and I interact with loan officers all day, every day, whether they work for our company or your company
Right.
or all over the country. My mission is still, how do I educate folks to just go be better in their community and serve more families and put them into that path of homeownership? And then you get into, just think about all the political crap we have going on in our country. And it's the haves and it's the have-nots and it's the this or the that's. Man,
It's a huge divide.
A lot of it comes back to, if we could put more people into home ownership and wealth creation, then, future generations are going to benefit.
Absolutely. And I was watching a segment on, I think it's, what is it now? Boiling Point, something like that, where they were talking about how these days we should be measuring wealth based on home ownership versus how much money you have in the bank or your stature, things of that nature. And it made perfect sense because that is the driver for many years that has created that generational wealth.
Yep.
Even though you don't make $1 million a year type situation.
100%.
And that just brings a good point. And I think it is very telling as to where we're going. And hopefully we can continue to preach the good word and get folks to understand that this should be a top priority for you if you're not currently owning.
Well, the last time I checked, the interest rate on rent is still 100%.
100%. That's exactly right. 100%.
You're either paying your mortgage or your landlord's.
Yeah.
And that's the way people need it to take into it. And then there's also some really, you can almost do a whole nother segment, another show on this, but just the socioeconomic numbers that are affiliated with owning versus renting.
Sure.
Education levels, household income,
Absolutely.
marriage, number of kids, health. It's crazy, but you get back into this whole, every man wants his castle and every, woman wants her nest, right? It's how do we find that equilibrium between the two to help a better family connection there?
That's true.
So yeah, that should be another topic for one of
Absolutely.
these shows.
and it leads to interest rates. They're rising. People are seeing this. We're talking about crashes. When you see things like that interest rate and people say, well, rates are so high right now. And I tell them, well, you can have a 0% interest rate if you put 100% down, kind of back to your point.
Yeah.
And they look at me like, that's funny, but that's not possible. I know.
Yeah.
That's why you're sitting here in front of me and we're going over your options to provide you with the best one for you.
Right.
And I think people take it for granted as well. I don't know if it's a generational thing. You hear mixed messages when it comes to millennials. I personally am a millennial, but I would not be your stereotypical millennial, I guess, according to the blueprint, living on mom and dad's couch, don't know how debt works, don't know how credit works, things of that nature. But when I look at the statistics and I look at the spheres around me, I'm going, that's just not accurate. My friends are all entrepreneurs.
Not at all. It's kind of funny you say that because where I was going in my head was, I know a lot of millennials and I really don't know any that are actually still living with mom and dad.
Right.
So I don't know. That's where I guess the okay boomer comes from, right?
Yeah.
That'll be a recurring theme we have here. And it's not just millennials now, it's the whole next generation. So you got a few different things to unwrap there, right?
Sure.
Okay, so mortgage rates, they're pushing 6% now. If you're looking for down payment assistance, for example, with T-Shack yesterday or even today, there's a 7 handle on there. There's 7%. If you're getting 4% assistance with the Texas State Affordable Housing Corporation today. But, I go back, my first mortgage when I got it was 6 5/8 on the first lien.
Right.
And I had 8 1/4 on the second lien because I didn't have 20% to put down.
Yeah.
Which, by the way, is another important thing. The number of people that still, I guess, when they answer surveys that think you need 20% down is so high. I'm like, no, that is not the case. Don't pay attention to anything you see from the media.
Or your parents sometimes.
Or really your parents. Or Dave Ramsey.
Or Dave Ramsey. Wow, we were just talking about that. We absolutely were.
I love 99% of his stuff, except housing, right? Yeah, pay your debts on time, good. But you need a credit score, and you don't wait until you have 20%, or that $400,000 house will now be $600,000.
Right. And talking about the Dave Ramsey for just a moment.
Yeah.
I'm a fan of his ability to capture. I'm a fan of the way that he articulates to his demographic, but I believe that most of his demographic found him because they had hard times.
Yes.
And that being the case, when I tune in to listen to some of the stuff he says, I think back, well, mommy and daddy didn't give me any money. I had to leverage. I had to go into debt and get out of debt in order to be where I'm at today.
Right.
So if you're telling people that they shouldn't be doing or making a move until they have the funds to do so, they'd be waiting for a while.
A long while.
You know?
Yes. And we're not going to see home value because there is no crash. We're not going to see that $400,000 house all of a sudden be $200,000 next week.
Right.
It ain't going to happen.
No.
If anything, the trend is only going to continue to grow, which goes again back into home ownership, why it's important, because it's a hedge against inflation. That asset will grow.
Absolutely.
They're not making more land.
Yeah.
Except maybe Hawaii. But outside of that, they're not making more land. But yeah, so with mortgage rates rising, okay, so don't think, well, gosh, my cousins, ex-college roommates, brothers, sisters, girlfriends, dad just refinanced and got a 1.99% mortgage 2 years ago. That time has come and gone. And it was so artificially created by the Federal Reserve that's never going to come back again.
Right.
Ever. If we see rates get that low again, then that means we have way bigger problems that we should be worried about.
I agree. Mind you, without another pandemic or something that alters our ability to produce, our ability to earn income, our ability to get out of the house in some cases.
Right. A mortgage is still going to be, it's still cheap money.
Yeah.
I mean, you compare that to your credit cards or your car payment, or obviously the 100% you're paying in rent.
Yeah.
It's still cheap. And the point just needs to be finding a payment that's comfortable for you. And if that's finding a house that's comfortable for you, if that's managing what can you afford? And if that means, you know what, hey, maybe you have these other issues in your credit that you need to fix, or where I get concerned is where I see 30-year-olds with $1,000 car payments.
Yeah. And still renting.
And still renting. And I'm like, and that thing, you're underwater by 30% when you drive it off the lot.
Absolutely.
So full circle back to the Dave Ramsey thing.
I don't know if that has to do with social media and the ability to have this facade and how we took to it, in addition to the next generation that's taking to it and wants to continue to paint this picture and truly having their priorities out of whack.
Yeah. I don't know. We could blame the Kardashians. We could blame Instagram. I mean, there's a lot of things to blame. There's no question that some priorities are out of whack, and maybe there does need to be a reset. Maybe a wake up call with rates at 6% is what needs to happen for people. Oh man, I need to get serious about this.
Yeah.
How do I put myself into a position where I'm in a forced savings type of situation? I should buy a house.
Yeah.
I should own a house. That's kind of where my philosophy really kind of brings me is, okay, financial literacy, super important, but you know what? You do need to have a credit score. I mean, yes, technically, Dave is right. You don't need a score to get an FHA mortgage or a VA mortgage, but you know what? You're going to pay for that more than you would if you had a credit score. And then there's other bits of responsibility that just come with building credit. So when you speak socioeconomically, I think there definitely needs to be financial literacy instituted back into school programs. And I've seen a lot of mortgage professionals go out there and try and create opportunities to, sponsor stuff at schools and do little financial literacy trainings, but it really needs to be institutionalized so that way people actually understand. I think that would also help them as they get older in life to realize that, the government just keeps printing money. That's not very responsible.
Right. And some don't even understand that concept.
Right. They don't know. The government's just going to print more. Then what? Now, you think $6 for a dozen eggs is good? It'll be $8 next month.
And I hate to say it, but those are the same ones that are looking in their bank account or mailbox for that stimulus check.
Right.
And really not caring how it affects everything else. Not looking down the road, even 5-10 years down the road, on how something like that affects that person in their life. So I want to get into, obviously, the current market, what you believe, all that good stuff. But before that, I had a question, which is, so I'm doing a lot of coaching, mentoring these days. I'm doing a lot of presenting, education, providing things of that nature. For you, running the mortgage company, and you're not originating, correct?
No,
okay.
No, I'm not originating.
So how are you staying current and relevant with your loan officers, which in my opinion, you've already earned the right and ability to, I know that you're
I appreciate
current.
that.
No, absolutely. But with them, does it, because you're inherently on these boards and going through the Congress and things of that nature, does it automatically come with that? Or are you still having to hands-on with?
Still hands-on. It's everything. It was one of our other EVPs said yesterday, I wish I could just clone you. And I'm like, well, me too.
Me too. This isn't Gremlins,
and
though.
in fact, I'm going to DC on Monday, right? I shouldn't say storm the halls of Congress anymore. Some bunch of people screwed that up.
Be careful.
Screwed that up for us. But I'm going to DC to lobby our congressmen and senators on several things that ultimately impact mortgage and ultimately consumers, right? So very engaged in that, very involved with the Mortgage Bankers Association, the National Association of Mortgage Brokers, even local associations.
Okay.
So I got to block out time for that.
Sure.
And then I'm also just a geek. So I wake up in the morning after I work out. I mean, I'm sitting there and I'm seeing, okay, what are the news articles that came out that are mortgage related, not what's going on with Johnny Depp's divorce, but mortgage related.
She hit him, by the way.
And he cut his finger. And so speaking of, technology adoption, I use Twitter a lot.
Okay.
I get there's a lot of good data, people that I follow, economists, other mortgage professionals, and that's where I get a lot of charts. I personally take time every single day to put out new content in kind of my micro blog,
and
if you will.
Content,
yes, absolutely. Because I'm trying to promote and give tools again to the professionals that follow me, charts, data, graphs,
right?
Anything that they could share within their sphere of influence to help them understand, okay, why we're not going into a housing crash. Right. This is what's happening with mortgage rates, and here's an easy way to explain it. And then all the way down to, hey, here's why it's important to be in touch with your sphere of influence.
Sure.
But yes, you got to have dedication and focus, and it's kind of like exercising. No one likes to do it, but you just have to.
Right. No, it's true. You said exercise, and I compare it to taking a shower or a bath, either one. But no matter what, I hope you do it daily.
Right. Brushing your teeth. I mean, dude, I hate running, but I love how I feel after I'm done. So it takes time and dedication, and I've got a library of resources that I go to. I sit in on a lot of conference calls industry-wide to pull data and find out, okay, what's happening in Washington, D.C., what's happening with even the state regulators, of how are their rules going to impact our originators and their ability to serve consumers in their marketplace.
Right.
So yeah, it's passion. Passion is where it comes
I like
from.
it. I'm right there with you. I mean, it's nice to meet an individual that has and I don't know, same level of passion. Obviously, you've taken it further, been in the game a little bit longer, but as I say, it's therapeutic to have these kind of conversations.
Yes. No, it really is. And I leave. How old are you? 35. Okay. See, you're not that much younger than me.
Heck no. Just don't say I'm old.
Okay, boomer. And it's great to see, I guess the next generation, right? That there are professionals like you that are glomming into this and realize, man, we really do serve a purpose. We really do have to go out and educate people, whether they're consumers, whether they're referral partners, whether they're industry colleagues. Right. Because same thing, I'm very concerned about other people that are licensed.
You and me both.
Because
you're right.
If they do something that screws up, on my reputation, I am not going to be happy.
Right.
And so, so you really just have to be tuned in with your environment and your community and go from there.
I like it. I really like it. So you have in the mortgage, and you guys have how many branches now?
Oh gosh. Mortgage Financial Services. My focus is right now on broker and non-delegated correspondents.
Okay,
so our wholesale division. But on the retail side, we probably got 18 branches now.
Okay.
We're now licensed in 14 states.
That's awesome.
So yeah, it's pretty remarkable. We started with one office with 8 people on June 1 of 2015. And here we are now today with about 300 employees. We did $1.7 billion last year and servicing loans and multiple channels in 14 states. I mean,
and you guys are servicing loans as well. Smart.
So
move.
it's a wild ride,
as they say. That's awesome.
But again, I think it comes from leadership and passion and finding like-minded professionals that want to work with you and
regardless of the company. And I think that's where, I don't know if there were many before me like that, but I could care less what mortgage company you're from. And like you were saying, I want to educate to the best of my ability, because as they say, when the tide rises, it lifts all the boats, right?
Yes, it does.
And I think for example, this podcast, there's not any podcasts out there that are able to have industry discussions with, or I should say locally, that have industry discussions with other like-minded individuals, other professionals that are working towards the same goal.
I 100% agree with that. That's why I was like, dude, you got to get me on your show.
Yeah, that's awesome. Absolutely.
Got some hot sports opinions to get out there.
And we'll get into that too. Heck yeah.
And rising tides raises all ships. And at the same time too, when the tide goes out, you can see who's wearing underwear and who's not.
That's awesome. I love that. I've never heard that variation of it, but I'm adding it to my repertoire.
Yeah, no, it goes both ways.
That is very true.
Yeah.
So now that everybody knows who you are, where you come from, your background, and why they should listen to this next piece of it, I want to talk about the shift in the market. If you've seen a shift, not only in just mortgage rates, but I'm talking about from paper to digital, from in-person to digital, social,
right?
All of the things that we've seen in the last, I would say it started maybe about 7 years ago when social media started to take place, and you're seeing younger folks come into our industry and doing things that we go, well, that took me this long to do, and you just set it on autopilot? Okay.
Yeah. There's a lot to unpack there. So the shift from how we do business or how consumers get information about mortgages has been nothing short of remarkable. It used to be where, people want to buy a house. Remember Century 21, they had the big golden jackets. I mean, that was, that was how we kind of grew up thinking, okay, that's how we buy a house. I need to go find that realtor that has the big golden jacket, and then they're going to introduce me to a mortgage person.
Right.
Well, and then really, Zillow came.
Yep.
And now consumers, they already know the house before they find a realtor to go take them there, but they still need a professional to be there with them.
100%. Yeah.
The same thing kind of with mortgages. So, a lot of, and it's not just demographic here. I think it's just everybody.
Yeah.
Everybody's now, they're going online, they're hitting Google, they're looking up stuff about a mortgage before they go actually talk with somebody. But at the end of the day, though, that's where people get information. But when it boils down to actually getting their loan, they still need to have the interaction with a live human being.
Right. And it's that guidance factor, that advisory piece, that expert piece. And me personally, I've hired quite a few new to the business loan officers, and the goal is to train them, educate them.
No bad habits.
No bad habits at all. That's right. No big egos yet.
Right. Yet.
I said, yeah. Go ahead.
Where I was going with that, though, is it's kind of funny, and this is interesting. So, because I'm a student of the business, I'm a geek, I like to get loans from my competitors.
Yeah.
So I've gotten loans from 3 different, very large, more online lenders.
Sure.
And the most recent one that I did, because I actually I refinanced one of my houses, one of my properties, but it was a 100% digital online company. I don't want to name them, but they have some Zoom issues these days. there's a hint there. And overall, it was decent. But then again, I'm an easy borrower, and I'm also in the mortgage business. So I processed my own loan. And for your listeners that don't know what that means, it means gathering and sorting and putting together a lot of paperwork.
Right.
I did it all myself. But again, I'm in the business. I knew what I was doing.
It's very true.
And I equate that, and of course, and then it was a refinance. I mean, so the payment's going down. There's nothing difficult about putting my loan together. But if I equated that to Joe and Mary first-time home buyers, they're going to struggle with that, especially if they're not putting 20% down and have pristine credit.
Yep.
I mean, your perfect credit profile. They're going to struggle because the online interaction, it's just that. It's online.
Right.
I didn't talk to one person on the phone.
Wow.
It was literally just emails going back and forth. And I knew that my work was being done on my loan in India.
Right.
It was done off overseas because all the email communication that would come back was coming back at 3 and 4 o'clock in the morning.
I was going to say, now I work with a developers out of
So I mean, which there's nothing wrong with that business model, and it is what it is. But again, if you're the first time home buyer, man, you need somebody local at the end of the day that's going to sit down with you, hold your hand, guide you, present you options. That was another thing that I find that concerns me is a lot of these online places will just say, here's your rate.
Right.
Well, what does that do? I've seen tens of thousands of loans in the 24 years I've been doing this, and not one or two families are alike. Some situations where, hey, you know what? They're going to be in that house for 15 years. This is a forever home. it's worth, and they've got some extra cash. It's better for them financially to pay some points and buy that interest rate down a little bit. Or, man, these guys are really strapped for cash. We need to help them out so that way they're not one flat tire away from really being in trouble.
Right.
So, you know what? But hey, they can afford a little bit of a higher interest rate. And you know what? Now it's going to reduce their closing cost by $4,000, which they'll be able to keep in their pocket because, well, now they're in the house. They're going to buy window treatments and a lawnmower.
Mm-hmm.
But again, that's where the local mortgage provider, consultant, advisor, professional role really comes into play. So internet, whether it's social media or YouTube or anything else, great places to go kind of get some basics.
Sure.
Like, what is a mortgage?
Sure.
How does a mortgage work? I pay principal and interest. What is a debt to income? It's some basic information, good knowledge. But at the end of the day, my advice to anyone, work with a local mortgage professional, whether they're my company, your company, or any other company out there. Mm-hmm. And then I also recommend that you work with a licensed mortgage professional.
100%. Yeah. And I was actually going to ask that
Yes.
is, do you believe, and there's no right answer, but do you believe that pay structure has anything to do with the level of expertise that you can get? And I'm talking maybe comparing Walmart to Nordstrom type situation.
Yeah, it 100% does. And man, I'm trying to be politically correct here and not be just.
We don't have to be PC on this show.
Okay, all right, good.
No, this is mortgage, baby.
This is mortgage. Well, good. One of the great challenges that we have in the industry is how do we deliver the Nordstrom service with the Walmart price?
Yeah.
Very, very challenging to do. And so you're going to have to kind of find a way to meet in the middle somewhere. And again, that's where I think it boils down to options.
Right.
And if you're paying too high a rate, you should question it. And if it's too good to be true, it probably is. Now, where I say licensed, and what I mean by that for folks that don't know, if a mortgage person works for a depository institution, a bank or credit union, they don't have to be licensed, which means they didn't go take a bunch of testing and education hours and everything else. They could literally be, and not that there's anything wrong with bank tellers, we love bank tellers, but they could literally be the bank teller and also be your mortgage advisor and also be the guy that's going to get you a car loan and also give you a credit card application. Well, when I'm buying a house, I want somebody that's focused just on one thing.
Right.
What is that saying? The jack of all trades, the
master of none.
I want to work with somebody that is just a mortgage professional. Mm-hmm. I'm trusting you, Mark, because you're going to guide me and my family here on this journey. I mean, holy cow, we're going to be in this house. This is huge. I'm borrowing $300,000. What am I going to do? I'd rather you be that guy that's going to give me options than, hey, and also you could fill this out here and we could refinance your car and get you information. Yeah. And oh, by the way, if you open a deposit checking account, we'll give you $500 gift card. I mean,
and 1% back on your credit card.
Right. So you kind of get what you pay for.
Yeah.
And I do believe that when it boils down to, well, if you think it's expensive to hire a professional, then go ahead and hire an amateur
and find out.
And then at the same time too, and this is always ironic as well. There's also another very popular company that everybody hears their names, hear them on the radio and the TV and the sports and everything else 8 million times a day, and their rates are super high.
Yeah.
Well, and then everybody thinks, oh, well, but I push this button, I'm going to get the best deal ever. And it's like, well, no, who do you think's paying for all that advertising?
Right. That's very true.
I mean, so it's paid for somehow. It's paid for by the consumer. And then just to get more into community focused, I think there's something big about local. Think about when COVID first came out, right? Everyone was like, oh, we got to go support our local, restaurants and local bars and local companies. Well, it's like, well, dude, I'm here local too.
That's right. That's right.
I shop at the same HEB you do.
That's so true.
Come sit down with me. I've got a vested interest in making sure that I'm going to put you into a house that you and your family are going to live in comfortably and not be foreclosed on.
And I have to almost say that, well, no, I'm just going to say it. I believe it has to do with our attention span and our lack of ability to stay focused on one effort, if that makes sense. Because as you mentioned, we did. Everybody was like, let's go support our local business. And then that lasted for a good, I don't know, maybe week, 2 weeks. And then we go, oh, next shiny object.
Right.
So it's the same concept with mortgage or anything else. But mortgage real estate, something you have to have in order, like we were saying at the beginning, to become any close to wealth in your life. So yeah, that's a tough concept for most to gain.
It is, but I'm going to come back to, And this is where I think, the education early on is important to understand. Okay, I'm not buying a pair of shoes on Amazon.
Right.
I'm borrowing a large, giant chunk of money that I'm going to have to pay back. But I'm also buying this big house, real estate, that now my family's going to be in. A pair of shoes I could just return.
Right.
A house and a mortgage, you can't just return.
No, legally tied to it.
Yeah, there's a lot of, that's a very simple way of putting it. But yeah, there's a lot of moving parts there. But yeah, no, I mean, that's where, I think that local professional is so big. Same thing ties to, real estate.
Mm-hmm.
I mean, I hear, people that have bought homes sight unseen, and that blows my mind. I could show you as many pretty pictures as you want to see.
Right.
But if there's a dump or sewage leak next door, you wouldn't know.
No clue. Yeah. And that's happening right now.
I know it is. I know it is.
Happening.
I'm hearing about it. Yeah.
So before we get into that piece of it, I just wanted to say a shameless plug. That is why I came up with reviewmymortgage.com, essentially to help consumers out there that have absolutely no clue what they're getting into, educate themselves on different programs that they potentially can qualify for.
Mm-hmm.
The literature behind it, the key points to it, the positives and negatives to each program. Most lenders, most advertisers, most anyone in this industry nationally is utilizing rate as their only means of capture. And it drives me insane as well, because I will get a customer, and I do originate here and there. My team's still running full speed, but I love getting a customer that says, I need the best rate. And they've got a 650 credit score and 3.5 to put down or 5% to put down. And we're able to show them other options like removing mortgage insurance from there. And they're like, how do you have this stuff? And for me, I want to say, only we have these products, but that's not the truth.
Everybody does.
Everybody has them.
Right.
It has a lot to do with the lack of education, lack of drive for those loan officers out there, the lack of thirst for wanting to know more in regards to the programs, to become that expert, to provide those options, things of that nature. But I do believe as we move forward and real estate mortgage becoming much more difficult, margin shrinking, inventory down, so there's less transactions going around, we're going to see a lot of fallout. At least that's what I'm thinking.
We will, and it's not a shameless plug. That's an important and very important plug. Because I've looked on your website and I was like, man, this is actually really cool. There's some good stuff
about
on
to
there.
launch version 2 of it
cool.
In about 2 months, and it is a completely different experience.
Oh, wow.
We've created a borrower dashboard, a sponsor dashboard, to where they can save their programs, come back to it, play with their credit scores. I mean, we put a lot of money into it.
Oh, that's great.
Yeah. The company wasn't founded to make money. It was truly to educate.
Resource.
And then it turned into something. And we're going, holy cow, we take all this money and let's do another website that is the same premise, but everything we want now.
That's great. Now you're going to become an app?
Who knows? Who knows?
I mean, that's the next evolution,
next
right?
step, correct.
No, it's that education and being a resource is so important.
Yeah.
And again, whether they get their loan from you or someone else, that's irrelevant for the purpose of it, which is to just educate and help people make informed decisions about where they're going to be shopping. And it's funny, you mentioned folks that may not, originators, people in the mortgage business that may not, just don't know. So consider this. In 2020, there were 28,000 licensed mortgage originators in the state of Texas. In 2021, that number ballooned to 44,000.
Wow.
So now why, man, that's a lot of growth. You know why? Because
wait, let me tell you. It's because what we do is easy.
Right.
And you can make a quick buck.
Absolutely.
Sign me up.
Sign me up. And it's crazy, but yeah, I mean, when rates were at 2%, I mean, anybody could do a mortgage.
Sure.
You're doing a refinance. There's not a lot of structure to it. I mean, in that case, you're going from 4% to 2%. Yeah, let's do it. Well, now everybody's at a 2% mortgage, or not literally, but the refinances are gone.
The opportunities are gone. Yeah, correct.
And so now the folks that just jumped into the business are now the people that are going out there and they're trying to get more loans. But again, they don't even know what they're offering, or there are other programs out there, or loans with borrower paid or lender paid mortgage insurance, or you know what? This house is just outside the city limits and you qualify for this. And here's USDA or here's, hey, you're a first time buyer and you fall into this bucket. We can get you a literally a tax credit on your return for as long as you're living in this house. tons of different
Right.
programs out there. So again, so we're working with the trusted, local, experienced, licensed mortgage originator.
Absolutely.
is super important.
So talking about the current market, and this is the moment that I believe everybody has been waiting for so that they can get their taste of what's going on in our industry from some experts that, in my opinion, we have a pretty good grasp of what's going on. And it's unfortunate when we jump into Google, the Google machine, as I would call it, to type in mortgage news, and all you hear is mortgage applications have shrunk 60%. Rates are on the rise, all of those things, but they're not giving the perspective of refinances are gone. You know,
there's a bigger picture.
That's exactly right.
Yeah.
Of course, applications are going to go down when there's no opportunities for refinances. And unfortunately, there's a lot of companies out there that did over leverage to employees, marketing efforts, all of those things geared towards refinances, thinking this was going to last longer than it did.
Right.
And then got caught with their pants down when the tide went.
Yep, absolutely.
You know?
They're not wearing shorts.
I love it.
Yes. First of all, when you go into that, I think there's a lot of clickbait out there.
Yeah.
Everybody is looking for clicks, and it's not just the Google machine. I see it on social. I see it on Facebook. I see it on Twitter, YouTube. There's a lot of bad YouTube stuff.
Yeah,
out
no, you're
there.
right. You're right.
And I can't even sit through a lot of it because I'm like, if you try and if you do a little bit of research on some of those YouTube guys, they're new to housing. So they're
Very new to housing,
Right.
and they're using talking points. I've got one guy that I every once in a while. Matter of fact, I'm going to do a reaction video to all of these wahoos out there.
Love it.
And
poke the bear.
absolutely, yes. They've got all these followers, and everybody's going, "Yeah, good point." I got one guy that's talking about there's bubble going to happen because in the last 5 years, everybody got arms. And I'm like, dude, less than 1% in the last 10 years took out an arm.
Right.
There was no need for it.
And actually, the ultimate irony is, okay, think back to 05, 04, 05, 06. There were a lot of people that got arms back then. Well, that actually worked out pretty good for them.
Right.
Because rates were
dropped,
only going down.
That's so true.
That's not what caused the crash. What caused the crash was basically fraud, giving loans to people that made $30,000 a year and putting on their loan application that they made $300,000 a year. And that wasn't really driven, I think, by the mortgage loan originators per se. It was driven from Wall Street with a thirst for loans.
Right.
And this is what's kind of interesting. So to draw a parallel, in 2003, there was a refi boom. And that really was the mother of all refinance booms. Yeah, we had record numbers in 2020 and 2021 based off of sheer volume because loan sizes were so high.
Sure.
But think back to 2003, we also did about $4 trillion worth of refinances. And back then, the conforming loan limit was $220,000.
Wow.
So a lot more units back then
Sure.
because this was people coming off of the whole decade of the 80s and 90s that were now refinancing.
Makes sense. In the 8s and 9s
right.
and 10% coming down.
And they were refinancing from 7 to 5%. So then what happened when industry ballooned and got giant and big and all these loans came in? Well, then all those loans went away because rates started to go back up. All the refis were gone. So that's when, Wall Street started saying, well, we need more loans. How do we get more loans? And that was when you started to see, stated income.
Right.
No job, no assets.
No problem.
No problem. I mean, so that's when the exotic loan program started to come into play. And then it was really a lot of back behind the scenes Wall Street activity with packaging these loans up and dividing them up into strips and then selling bits and pieces to different pension funds and Icelandic villages.
Absolutely. And guys, listeners, you can watch The Big Short.
Yes.
Great movie about it. And Marginal Call with Demi Moore.
Yeah, Margin Call. Yeah.
Yeah, there you go.
That's great movie. Very
It is,
accurate to what happened with Bear Stearns. So what happened now is, now all these refinances are gone, but guess what? There's actually laws in place that say that we need to verify that you could actually pay this loan back before we give it to you.
Right.
So unless Congress is going to undo Dodd-Frank and these laws that made sure that before we lend you money, you're going to make sure you pay it back, those programs aren't coming back. So we're not going to get into a position where all of a sudden we have, we're giving $300,000 loans where people are making $30,000 and saying they're making $300,000. That's not going to happen.
Right.
So that's just one reason why there's not going to be any crash.
Absolutely.
Another reason why there's not going to be any crash, and what this drives me nuts because not enough people are talking about it, but demographically speaking, and you're talking about just our population growth in general. It's been like the millennials have been like a wave coming. I mean, Gen X, And then this wave of millennials coming through. Well, and then guess what's right behind the millennials? The Gen Zers. And their wave is just as large. Today in this country, there's 4.7 million 30-year-olds.
Wow.
And guess what? They don't want to live with mom and dad.
No.
And they're eventually going to do what?
Buy, hopefully, or rent.
Get married.
Oh, that too.
I mean, they're going to get married. They're going to get a dog. They're going to have a baby.
Well, see, these days, and I don't want to bring too much politics into it, we're finding that most are not. Most are staying single. Most aren't getting married. Most aren't having the kids.
It's happening later.
Touche. Yeah.
So it's not that they're not. It's just happening later. I mean, shoot. I mean, I'm a Gen Xer, but damn, I mean, my daughter, I was 35.
You're a spring chicken. I don't know what you're talking about.
Yeah, I was 35 when I had my first kid, but I was a late bloomer compared to a lot of my other buddies.
Sure.
I mean, their kids are getting out of high school now. I'm like, I still got a ways to go.
Yeah.
But they're just waiting longer. Mm-hmm. So eventually it's going to catch up.
Yeah.
It's human nature. But
we hope that stays human nature.
Yes. I mean, that's good for the planet. I mean, that's good for long-term civilization. So nonetheless, yeah, I mean, demographically speaking, demand is always going to be out there. Mm-hmm. I mean, eventually there comes a time where, you know what? Again, interest on rent, 100%. Wouldn't you rather own your own house?
Absolutely.
It is a forced savings.
And another thing that I don't know if I mentioned it on my recent video, but I'm thinking about it now, and I haven't looked up the statistic, but I'm wondering if you think the same. Back then, when you had all of the stated income, stated assets, offering folks multiple loans, I wonder what the statistic of when that happened, how many primary residents actually went belly up versus how many borrowers were over leveraged with investment properties that when that took place, the tenants couldn't pay their rent. The owner or new to the business investor owns this property and they never should have owned it in the first place. We're relying on that rent.
Right.
And then they go belly up.
I'm sure I can get that from anecdotally speaking. I'm sure I can get that data.
That'd be nice to know.
I can get that data. Anecdotally speaking and just experience-wise. So think about this. A lot of these loans went bad in, 08?
Right.
09?
It started in 08, 09.
I mean, that's
trickled on to 12.
So the bust started to happen, Wall Street started to fall apart.
Oh, yeah. Real quick.
in 06 and 07 when people realized that, oh man, these people can't pay it back. Well, then it really started to impact the whole global economy. And then that's when you started to see layoffs and a true recession, right? I mean, there was no liquidity in the marketplace. That was a crash. And that's where the foreclosures started to happen because, well, yeah, it really wasn't, it was people didn't have jobs. They couldn't pay their bills. Now, did you have some jingle mail? Yeah, there was a lot of jingle mail. And what I'm referring to is with jingle mail, people would actually like put their keys in an envelope and mail them back to whoever the owner of the mortgage was.
No way.
Yeah. So
wow.
I heard that term coined in the Midwinter Housing Executive Conference in Salt Lake City.
Wow.
In 2010.
Now, were people actually doing that?
People were actually doing that.
Wow.
Yeah. So you had this massive property appreciation, right? And there was a buzz, but I'll do some research and you could do a follow-up segment on that little piece. I'll find out. But where I'm going with that too is, okay, here's another reason why there won't be a crash. What did we learn from COVID?
We learned that we could still sustain at least our employment if we have access to the internet and computer.
Well, there's that for sure. 100% there. Where I was leaning with that is the government's not going to let that happen again.
Ah, touche.
So, I mean, there were a lot of people that lost their jobs when COVID came out. I mean, it was just shut the economy down. What did the government do? They said, you don't need to make your payment.
That's true. Yeah.
And they implemented forbearance program for up to 12 months. Interestingly enough, now vast majority of loans are now out of forbearance.
Yeah. I mean, when I was looking at that was it gave me hope, to be honest, because you've got so many Americans that did get affected by COVID. Right. And did utilize forbearance and did get back on the right side of the tracks quickly. Yes. I mean, and there were a lot of people, just like anything else from the government. Did they come running out of the gate too fast and not think about the unintended consequences? Yes. And that's what broke the funding mechanism for a while with mortgages. And were people getting it that didn't need it? Yeah, there was a lot of that too. Absolutely.
But for the folks that did need the forbearance, I mean, it was a good program. So, I mean, there were people that legitimately couldn't make their mortgage payments. They were able to stay in their house. So will you see some clickbait about one-offs? Absolutely. But I mean, you're less than 3% of all loans that went into forbearance are still in.
Absolutely.
Less than 3%. I mean, you're talking trillions of dollars worth of home loans.
Right.
And so the government is now going to look at that forever and go, man, okay, so if we do have another giant recession where now the economy starts falling apart and we're having mass layoffs and everything else, I get 100% guarantee you they're going to come out with some other type of forbearance program like that to not allow the forbearance or not allow the foreclosure crash.
Right.
From 2010, 2011, 2012 take shape again.
And that's pretty cool to hear because yesterday I did a quick video with one of my loan officers, and I was talking about, is a recession coming? And I think, yes, it is coming. It's possible that it wouldn't if rates do continue to rise and it slows it down, all that jazz, but I do believe it's going to come. Is it going to be 6 months, 8 months, a year, 2 years? I don't know. But what's cool about that is this recession is not going to be like any other recession that we've had, in my opinion, because typically recessions affect real estate as well. In this case, and in my opinion, it's not going to affect real estate too much at all. At least not in Texas. And I can only speak for Texas, y'all.
Well, that's true. I mean, everybody's flocking here, and that's why we have, the inventory issue that we do today. No, what we do have is an unhealthy market.
Okay. Yeah.
And it's unhealthy for a couple of reasons. Simply, there's not enough inventory. So, I mean, a positive sign that came out yesterday, housing starts are finally back to like a 2006 level. Right. That's very important. The problem is there's not enough housing completions going on right now to fill that gap or to fill that void. That eventually will work itself out once we get supply chain issues going back. I kind of make fun of my political friends when they talk about immigration stuff. It's like, no, we need those workers.
Oh, yeah.
we
absolutely do.
We need people to build homes.
And they ask why, and I say, well, are you going to do it?
Yeah, exactly. It's hot dogist.
That's right.
So we need people to build houses. That inventory will eventually catch back up. But here's another reason. We're not going to see property values drop because there's still such large demand.
Yeah.
Now, will the home price appreciation slow down? God, yes.
We hope so.
And it needs to
be honest. Yeah.
It's not sustainable to have. I mean, I saw my property tax bills.
You and me. They just came out like last week.
I mean, yeah. So
my wife sent it to me in a text and said, "You see this?"
I know it's not 420 anymore, but I want whatever they were smoking on some of those. But I think this is my hot sports opinion here. I think we basically got like 3 years worth of home price appreciation in the last year and a half.
I agree. It's also comparable to what I have actually been saying is we took 5 years of growth in regards to human connection, the way we do business, the way businesses have become streamlined and more automated. That was going to take, let's say, 5 to 10 years and shrunk it into 2 because they had to. They had all of these things, Walmart's, all the companies out there had all these things that they were testing to be able to do these things already. And they went, let's just deploy it. Let's go.
We had to roll it out.
That's
all of a sudden, now I went to my office every day, but I was the only one there.
You and me both.
And it's because, people needed to see that there was a captain at the ship, right?
Yep.
And so it's like, but there was 8,000 square feet all by myself. I think that was actually, there were decades where I was looking in the parking lot. I was the only one in the building.
I believe that. I believe that.
It's like, it's kind of creepy. I was thinking, man, it's like The Shining. But yeah, so you had to roll it out. So it did change the way that we had to do business. Now we're doing Zoom more often or Teams or GoToMeeting, whatever,
virtual,
wherever you're at. It's a virtual environment now. And what's funny, and this can go down to another rabbit hole, but everyone always talks about, the robots are going to come take our jobs. No, actually, they're not. They're actually going to.
Well, your job, maybe.
They're actually just going to force people to evolve and change the way we do business and only get more efficient.
Absolutely.
I mean, I have hope for my daughter. I mean, I swear that whatever she does with her life, that job has probably not even been invented yet.
I agree 100%. I mean, I have an 8-year-old. She's 8. Yeah, she's 8. So relate.
So 8 going on 19.
There you go.
Yes, just like mine.
Yes.
Oh,
yes.
Lots of sass.
That's so true.
So, will the way that we do business continue to evolve? Yes. But at the end of the day, when we come back down to, here's the largest financial decision of your life.
Right.
Whether I'm meeting in person or on a Zoom call with you, and I'm here locally, that's important. Because if I do anything wrong, you know where my office is at. You can still come find me.
And with 100% of Americans should be looking to purchase, if you don't already, I believe the statistic is like 80% of them will need to finance.
Yeah. Oh, yeah. No. I mean, it's huge. I want to touch on another point too, and that is whenever you hear the news media quote an interest rate, mortgage rates are now at 5%. yes, if you want to use it as a barometer, maybe, but don't give it much credibility.
Correct.
And that's where I think a lot of the misinformation is coming from, because that statistic that they quote, that little interest rate quote they throw out there, 5%. Well, that's based on a 740 credit score, putting 20% down and paying one discount point.
In this location.
Yeah, in this location. So okay, well, that's great if you're that borrower buying in that location with the 740, putting 20% down. But that's not America. And you don't need to have 20% to put down in a house. The important thing that comes back down to is, what's the best way for you to save money in the long run and build wealth for your family? It's through homeownership.
Absolutely.
And because life is expensive, it is hard to just save money every month and put it away.
Mm-hmm.
So you could do it in your house.
That's a great place to start.
Yep.
At least. So as we wrap this thing up, God, I could go for another hour.
I know. we need some beers in here.
That's right.
Yeah.
You see the bar.
All right. There it is.
So the idea of consumers going online, looking for interest rates, things of that nature. Have you come across the Google tool that they have now?
Yes.
I think it's pretty damn accurate.
Yes.
And why
no.
I say that is because it doesn't have something associated with it like the clickbait that we're talking about.
Right.
It's simply data that they've gathered,
It's
put
based
into
on
a form.
Fannie Mae average and
Correct.
FHA average and VA average. I mean, they're pulling that based off of mortgage-backed securities that are being publicly traded.
Correct.
But again, I still come back to, so if you're using it just for informational, for like a barometer, yes, but don't get caught into the expectation that that's going to be for you.
Right.
Nor should you let that scare you.
Right.
If it don't take it for truth. I mean, go back, talk to that licensed mortgage professional that's going to actually listen to what your needs are and what your desires are, and then kind of custom tailor. Okay, here's door number 1, door number 2, door number 3, door number 4, door number 5. You pick.
Right. Here's the benefits. Here's the disadvantages.
Pros and
here's
cons
my
of each.
recommendation, but it's overall your decision.
Right.
So as we wrap this thing up, we've got mortgage rates on the rise nationally. Highest level since 2018, something like that.
Oh, 2011 now.
2011. There
Yeah.
you go. We passed
Yep.
it. Inventory shortage nationally.
Record lows.
Especially in Texas.
Unhealthy.
We've got misinformation all over the place, which I'm not a fan of censoring people or anything like that. It's out there. It's up to us as the professionals to educate folks and saying, hey, read the fine print. If you want to try it, go for it. And I'll be here when you come back.
With a lot of the stuff that's out there, find out what the motivation behind it is first.
Sure.
Before you give too much credence. And okay, why are the crash guys pushing that so much?
Right.
Are they trying to figure out the next meme stock?
Touche.
Or short something or Bitcoin? I mean,
who knows? Yeah, you're right.
Fine. Are they even in the business? Is probably a good place to start.
It's a great place to start. Yes, you are correct.
So don't, if you're going to listen to anything on the internet or the Google machines or TikTok or Facebook or anything else like that, just pause for a second and just think about what is their motivation.
Yeah. Take the extra step and go down their rabbit hole to find out who you're actually getting your information from.
Yes.
You know? So that being said, what's your prediction? What's going to happen in the next, let's say, I don't know, 6 months to a year?
Okay. So John's little crystal ball.
There we go.
It's funny. I need to send you this chart because
JC, dim the lights.
Yes, I need a little hat. I've got a really awesome little chart it kind of points out to be like the middle finger of inflation.
There we go. I like it.
And that we will hit peak inflation, not this year, but I think next year.
Okay.
I think, inflation's going to continue. It's too hard for it to stop. I mean, the Fed was really asleep at the wheel. They let this thing go way too long. I mean, we're probably going to have a 0.5 point increases from the Fed throughout for the rest of the year.
Sure.
I mean, and they're going to finally get the brakes on that. It will cause a recession. And and then inflation's going to come back down a little bit, which is a good thing. And then hopefully things will start to normalize. So I think we're going to hit peak inflation next year. I think we're going to see mortgage rates continue to rise probably for the next 6 months.
Sure.
And then we will again hit peak mortgage rates there too.
Right.
Because there's a lot of different factors in play with mortgage rates. Why do I think they're going to continue to go up? Because the Federal Reserve has like $2.7 trillion worth of mortgages on their balance sheet, which ironically enough is owned by us.
Right. And aren't they running that off again?
Yes. And so, how do you run off a 2% mortgage-backed security coupon right now when everyone else is trading at 5%?
Correct.
You sell it at a steep discount.
That's right. That's right.
And so they're going to continue to sell these at steep discounts, which is ultimately going to put more inflationary pressure onto existing new issued mortgage-backed securities. So, which the only way, if I'm an investor, I'm either going to find the best yield or the best discount. And so we're going to have these two competing forces. So that's going to drive mortgage rates up probably for the next 6 months or so. But then I think we'll teeter off and then we'll see them come back down. I think a healthy place is anywhere in that 4.5 to 6.5 range.
Absolutely.
I mean, for a long term, and it's still below historical mortgage rates.
It is. Yeah. Historically, we're 7.
Yes.
Right?
Yes.
Yeah.
Even 7.5. Something like
7.5,
that.
yep.
It's something like that. So crystal ball, we're going to hit peak inflation. So in a year from now, we're looking at a much better picture. Mortgage rates will continue to climb, but eventually they're going to teeter off to like in that same trend line. We will see it kind of shape back down. It's the middle finger.
The middle finger.
And then housing inventory. So good news is it's not as profitable for home flippers anymore as it used to be.
You're right.
And so
as one, yes, you're right.
So I mean that's see, I'm a buy and hold guy. So if there's less flippers that are wanting to buy inventory to turn it, then there's going to be less demand there,
right,
which is going to lead to ultimately more inventory. And when you don't think that, well, 1 or 2 houses here and there don't matter, it matters a lot.
Absolutely.
in this current environment. And then who knows how long the supply chain thing is going to come into play. But I think home builders, at the very least, at least now they've got more construction starts.
Right.
That's going to catch up in the next year. And so eventually we will see more completions and we'll get back to a healthy place.
How about all of these builders that started homes qualifying folks at your 2-3% interest rate? Now the homes are becoming completed and they're at 6.
Yeah.
Most
we
don't qualify.
No, we not most, but some. We do see a lot of that. And if they don't qualify, they don't qualify.
Yeah.
But there's buyers, there's demand right behind it.
Up.
So I will say this. I think there's some bad behavior from some of the builders right now.
I agree.
It's not the home buyer's fault that they can't get an appliance. It's already baked into the sales price of the contract.
Twice.
And when that borrower needs to have their lock extended, the builders should be chipping in and helping out.
Absolutely.
And I'll just leave that one there.
Let's sit that for a moment.
Yeah.
Sit that on the shelf. So as we close out, is there anything that you'd like to give in way of advice for loan officers, realtors, consumers, anything?
Yeah. For loan officers, really study your craft and know your why. And I go back to that first closing that I attended and saw the impact that we have, the positive impact that we have on people's lives. Know your why. And if you do things for the right reason, the money will follow.
Absolutely.
You should look at this as a career, not as a job. So now if you got in the business in the last couple of years because it was easier, but now you found that passion, great, continue on. And this goes back for realtors and loan officers. Communicate within your sphere of influence. Make sure people know what you do.
Right.
We're coming off 2 of the best years in the history of real estate and mortgage to arguably what's going to be in the next 2 years are going to be 2 of the toughest years in the history of real estate and mortgage. So the winners are going to be the folks that can have the most meaningful connections within their spheres of influence. And there's a theory that says, Dunbar's theorem that says that, average person can only have 150 face-to-face relationships. Well, that was obviously pre-Facebook.
Sure.
But if you take 150 and they know you as the go-to mortgage or real estate person, and you could utilize that to get into their 150, well, what's 150 square? 22,500.
There you go.
So now extrapolate that into what does social media do for you? So communicate with your sphere of influence and make sure people know what you do.
Absolutely.
It goes back to the basics. It's easier now with technology. And then for consumers that are looking to buy homes, don't rush into anything. Don't get caught up into the frenzy. If you didn't get that house, it wasn't meant to be.
I like that.
But just, it's just not the right one. The right one is when it happens.
Sure.
So keep the faith, educate. If you're renting right now, but you're thinking about buying, talk to a local licensed mortgage professional and start to even get some ideas of, okay, well, what would my payment look like at this? And kind of get some idea and start kind of playing with your own little budget and maybe look at, you know what, maybe I should refinance the car and, or maybe I should get a new car. Really figure out your personal finances, figure out what's a good payment, have realistic expectations. You're not going to borrow $400,000 for $1,000 a month, but have realistic expectations and just, keep your eye on the price.
I like that. John, it's been awesome.
Yes.
It truly
this
has.
is awesome.
And
Thanks
we're
for
going to
having
have to do this again.
Yes.
So that we can follow up on a lot of these
I know.
nuggets that
we did drop a lot of nuggets here. So mark the date and let's come back in 6 months and go, okay, where mortgage rates at.
I like that. Absolutely. Well, guys, gals out there listening, there were a lot of key factors in this episode that we can take to the bank in cash. I'm not going to go over all of them because there were so many in this episode. You can press rewind or you can share with a friend and view it together. But if you're getting something out of this, something of value, please like, subscribe, share with a friend. You can find us on all podcast platforms. In addition to a second show that we do, which is Millennial Market Talk, and it's just mortgage updates. It's important for you as a consumer, realtor, lender to stay up to date from an expert in regards to what's happening in your world. That being said, guys, I appreciate you continuing to support what we do here. It's all about education. I'm Mark Jones, your Millennial Mortgage expert, and you guys take it easy.
Adios.